Hello and welcome everyone to Almus Market Mornings, your daily dose of global financial updates. 80, the dreaded or look forward to level, depends on how you're positioned in the market, was achieved in the late hours of trading yesterday in the Indian markets. In the euro, of course, we broke the parity. In GBP, we broke the 1.18 levels. Morning, JK, a lot of action in the currency markets. Of course, today morning, things seem to be a bit better with rupee below 80 psychological mark while Euro and GBP have some sort of recovery. Take us through what's in store for us today.
Yeah, good morning. And yes, two milestones were reached yesterday. Euro trading quite below parity, and then dollar rupee trading above 80, although not in the OTC market, but definitely in the uh, you know derived spot rate from the currency futures market as well as the NDF market. Significance of euro below parity is that it is extremely psychological. If it sustains below that, definitely more losses will be there, and there are no significant change in the macro factors driving it. ECB has been slow to respond to the high inflation, and then European energy problems continue even as Russia shut down one of its supply pipeline of natural gas to Germany. Added to all these, it was political problems in Italy that actually triggered the ultimate fall through 1.00 on the euro. The European Central Bank, former European Central Bank President Draghi, and now who was heading as the Prime Minister in Italy, announced that he was resigning on Thursday after one of the allying partners, were not backing him in the confidence vote about over his plan to combat soaring prices. Division in the political parties over issues such as the rising cost of living and how to respond to Russia's invasion of Ukraine are being amplified by the approach of a general election due to be held in the first half of 2023. Now, the president has asked Draghi to continue and explore the possibility of continuation. The probabilities are that a new coalition may be worked out, or an early election may be called in the coming days, and it will be clear in the coming week in which way it is going. For some analysts, this is not new. Italy has always been harboring a lot of political crisis, and currency, of course, has reacted because the trend is on the downside, and this just acted as another trigger for the down move. The recovery since then is probably because the ECB meeting is ahead next week, and also because some of the key members of the Fed played down the chances of a 1% rate hike in the next Fed meeting. Coming to another milestone that was seen, 80 hit in USD INR after the OTC market closed, but it was always building up through the through the day. We opened with a gap like we did in the several days in the previous sessions, and then just did not go below the opening level at all, and that is a sign of what we call as runaway gaps. And runaway gaps are very dangerous, and they can actually create big moves. And I kind of noticed a hands-off approach from RBI yesterday. They were not sellers of our dollars to any great measure, despite we being closer to 80 levels. Now, what I observed, despite this move, which is threatening to break even higher, is that we have moved about 10% from just 1 year back level of 70 to 40. And we are also at extreme levels in the dollar index, rather 2-decade low in the dollar index. We are having a fall in oil prices, which is now kind of sustaining below 100, and more it sustains, and more fears of recession can even bring it lower. Also, India did get some advantage out of increasing its imports of oil from Russia at a good discount. These are not well factored in by the market in the USD INR, and the RBI and the government are actually exploring more measures to improve the flows. I feel that having moved 10%, maybe it may be a quick stop for the dollar rupee for some time. Watch the market developments in the global scenario, and then we'll take it forward from there. Uh, I mean, just a warning that it's not an end of the trend. I'm not saying we are ending the trend, but definitely a pause is possible, and we look forward to how things evolve in the global markets, as well as any regulatory measures that may be forthcoming from the authorities. On the US side, of course, we had another scorching inflation number. Wholesale price index surged to a new record from a year ago due to a big jump in energy prices. It tested 11.3%, the highest reading since 11.6% in March. Excluding energy, the core inflation also rose to 6.4% on a year-on-year basis. That was a slight fall from May. Again, this is adding to the inflation pressures, which was seen at 9.1% on the CPI, which was announced on Wednesday. The weekly jobless claims rose to like 44,000. Some small indications that the job market might be cooling off, but still data indicates that the number of people employed, unemployed, or rather less in US, and that is actually a rise in claims is often a leading indicator of recession, but it may be premature to take away that message at this point of time. On the US yields, a bit of replay of Wednesday when Treasury yields spiked after the PPI report showed another big jump, but they cooled off later with the buyers coming into the market, and more people focusing on recession fears. Also helping the bond yields to cool off was two of the hawkish members, Mr. Waller and James Bullard, played down the possibilities of 1% hike in the Fed meeting this month. They were cautious about the big rate hikes that it may be having on the economy, and mostly they are leaning on 0.75% hike. Of course, we have more data this week: retail sales, rather today, retail sales and industrial production, and also the Fed's very favorite gauge of inflation expectation, that is a Michigan survey, which is due to be announced today. On the stock market, it was more of cues taken from the results of major banks, JP Morgan and Morgan Stanley, who both of them reported poor numbers. Stocks fell and then recovered once again as the Fed members played down the possibilities of 1% rate hike in the Fed meeting coming up. A few more points. Canada dollar hit another multi-month high. Rather, USD Canada, despite this may be surprising to many who are watching the Canadian policy rate move, which was hiked by 1% early this week. But again, the fear is that Canada may be acting too fast, too soon. This is the other extreme that we are seeing, and the economy might be sharply slowing down in the coming days. This, combined with the fact that oil price has fallen in recent times, is working against the Canadian dollar. The other notable feature has been the dollar yen now slowly and steadily moving towards the 140 mark, another milestone in the currency market. I have a strong sense of some action from the authorities around 140 levels, even as the euro is trading at its two-decade low. Very interesting. Also important to note that Korean won has broken below, or rather USD Korean won has broken above the high seen in the wake of a pandemic in March 2020, and all the reactions are coming from due to the Japanese and so one-way weakness, and it is a competitive devaluation that we are seeing, and authorities are not hastening to stop that trend. China yuan also above 6.76 today. Of course, the bad data, rather industrial production and GDP data were disappointing from China. The slowdown is definitely on there. So all these factors, looking at it, I think a dollar is still ruling the roost in the markets, and it's very difficult to see it reversing anytime soon. We may have here and there some corrections in some pairs which are overdone, but definitely the trend is still on, unless there is some policy or reversal from US, and that looks very far away right now.
Okay, thank you, JK. And as guys JK mentioned, there might be a pause in the trend, not the end of the trend itself, and markets can continue to be very volatile. There are recession fears, of course, looming the markets, and yesterday's session was also a good example of the volatility. Keep managing your risk and avoid catching tops or fishing for bottoms. As the famous saying goes, markets can remain irrational longer than you can remain solvent. That's it from our end. Have a very good weekend. We'll see you all tomorrow. Thank you.